Hey, ladies and gentlemen, and welcome to the show on this Thursday, the 18th of August, 2022. Thank you for tuning in. I'm glad to have you guys here. And I'll tell you what, I'll tell you, maybe I'm just a little bit impatient. I made my first forecast about what's happening right now a long time ago, and kind of I'm watching what's happening with the Fed and stuff, and I'm just like, maybe I'm a little bit impatient, waiting for it to happen, but it could very well all unfold just exactly exactly like my initial forecasts were. Maybe just me being a little bit impatient. Maybe it's going to take just a little bit longer than I thought. But if you remember my original forecasts, well, there's a high probability we could experience some sort of a liquidity event problem. Like the system goes along, seems to be fairly stable, rational and stable, and all of a sudden, because the Feds went a little bit too far, boom, we get a 2008 type event, and then the Fed changes direction after that. It's very entirely possible we could get something like that happen. Let's start the charts right here. Take a look at what's going on. First thing I want to take a look at is Fed minutes from routers. And what we're looking at here is Fed minutes show more rate hikes in the pipeline, but the pace of the rate hikes could slow, So it looks like they're going to continue to hike until they think that they've got inflation under control. It says Federal Reserve officials saw little evidence last month that U.S. inflation pressures were easing, steeled themselves to force the economy to slow down by controlling an ongoing surge in prices, according to the minutes of their July 26 through 27 policy meeting. We're not explicitly hinting at a particular pace of coming rate increases, beginning with the September 2nd, 20th to 21st meeting. So basically what's happening is the Fed's holding their course with these rate hikes, and I can just see that they're just going to continue to squeeze. There's no policy changes so far. It's going to take a squeeze. It's going to take a considerable situation within the financial system and within the general economy to make the Fed change direction. But that's coming, because they're going to keep going until they get what's coming to them. I mean, it's like... Anyway, moving on, take a look at the silver price today. 1972. It's down 6 cents on the day so far. I can see that until the Fed changes direction, well, it's like this. They're going backwards from the way that things have to go. The system was structured back in 1914 by the Federal Reserve, and it's a system that always requires constant growth, and it always requires the creation of new credit to continue to constantly expand the monetary supply. And if you start to move in the reverse of that direction, like the Fed has been doing, you're going to get a collapse of the system. It's called deflation. That can come very suddenly, and it's extremely fast. See, bubbles take a long time to blow up and get big. But when they pop really fast. And that's the way with a deflating system. We're already seeing the beginning signs of a housing market. That's an awful lot of money is stored in houses. The 2008 crisis, that's one of the things it was about. It's mortgage-backed securities. Houses. The housing market popped. Housing market's starting to pop this time again. It's very similar to what's happening in 2008. Except China can't rescue us this time. They rescued us. They built ghost cities the size of Chicago to rescue the world economy. This time things look really bleak, and in order to rescue us, and they would absolutely have to, they're going to have to print multiple trillions of dollars There's no other way around it. Bail everything out again. Prop the system back up. And that's going to lead to hyperinflation. And it might be one of those things where when it actually happens, you could see silver, gold, cryptocurrencies all really take the moonshot we've all been waiting for years. Unbelievable moonshot. But the dollar? See, what's holding the dollar together right now is the hopes and dreams that the Fed's going to be able to continue with this tight monetary policy and quantitative tightening and raising interest rates, that they can continue and continue. But there's an end to this. They can't go that much further. And when they hit the end of the line, it's going to be the end of the line for the dollar. It's just like Kyle Bass said. They're just going to destroy the dollar. And ultimately, they've been moving in that direction since 1914. But the end of it is much quicker than the beginning. In the beginning, it's such a slow process. It's like watching paint dry, you know. But then toward the end, it speeds up faster and faster because it's running on an exponential. Cryptocurrency today, 1,120. That's in billions. So that's 1,120,380,000,000. No, 380. Anyway, when you get that numbers that big, it's hard to even fathom. That's a huge number. It's over $1 trillion in the industry, and we're looking at a Bitcoin price at 23,455 and Ethereum at 1,863. Dow Jones Industrial Average today is down 74 points so far in the day. 33,918. No, it's down 60 points. So see that 3,919 points over 3,000? That's what it was down to. It was down to 3,000. That's our bounce back right here. That's a little bit more. It's exceeded a bear market rally. In other words, a dead cat bounce. It's exceeded it a little bit, and it's got a little bit more staying power. But it could be what if the Fed continues tight, and see if the Fed right now just said, okay, boys, we've had enough. We're just going to go ahead and relent, you know, and we're not going to try to do more. Well, then this rally here the market would exceed this and go back up again, but they're not going to do that. They're going to keep pushing. And they're going to turn this right here. At least this is what I think is going to happen. I think they're going to turn it into a bear market rally or a dead cat bounce. And we're going to see this big collateral drop in the market. I don't know. It could go down like below 25,000. It could even head toward 20,000 rather suddenly. When it's going to happen, I would expect it to happen rather suddenly. And a credit. They could even get a credit freeze by doing this. And this is going to force them. I mean, they have always told you they're data dependent. This will force them back into printing, starting up the printers again. But this time, when they do this game, when they play this game this time, it's basically all over. When they start the printers up big time again this time, we're going to see what little disinflation that they create turn into massive inflation. Massive. And that's when we're really going to see the price of gold, silver, cryptos shoot to the moon, you know. But it's not going to be happy times. Just because maybe you guys got crypto, maybe you got gold, maybe you got silver, it's not going to be happy times. But it's particularly going to be hard on people that are deeply invested in the dollar and all of its forms. There's so many different forms of the dollar. The dollar comes in stocks and bonds in your portfolio is all dollar denominated. In fact, most everything you own in life is dollar denominated. When the dollar takes a huge hit, you're going to take a huge hit unless you're divested of the dollar. And it's very difficult to get divested of the dollar because it's intrinsic in everything that you have in your portfolio. Is mostly all dollar denominated. You got to get some little piece, at least a little piece of your portfolio out of the dollar denominated stuff and into some real hard tangible assets that are non-dollar denominated. And that's a very small amount of assets that gold, silver, in the real physical form, and cryptocurrencies are the only things that's non-dollar denominated assets, because they are money in their own right, not counting on the dollar, and they move independently from the dollar. You know, I mean, you can have the dollar losing value daily and gold and silver going up daily. Well, which would you rather have? The dollar's losing its purchasing power daily. People are trying to get out of it. And gold and silver are going up, denominated in dollars, equal to, if not above, the amount of the purchasing power being lost by the dollar. So if you have a hyperinflating dollar, and say the price of apples are doubling every day, you can go out and buy an apple. Price of apples are doubling every day. So one day the apple's $1 a piece, the next day they're $2 a piece, the next day they're $4 a piece. You can just bet your bottom dollar that the price of gold and silver, denominated in dollars, is going to be doubling every day. Going up and up and up and up and up. So you can still buy the same amount of apples with your gold and silver. But with the dollars, every day you're going to only get half as much. This is what we're talking about, you know? And this is why it's insurance. It's actually insurance against the loss of purchasing power of the fiat currencies. Stock market's starting to roll over right now. It's 60 points down. Now it's 100 points down. Just that quick. Since I've been chatting to you guys. Looking at oil today. Down $2.17 at $90 and... Oh, it's up. So why did I say down? It's up $2.17 at $90.28. Move index 117.70. Move index actually has broke below the trend line. The trend line was right about here, say 130 right now. Was the trend line. It broke below the trend line a few days ago. It's trend. It's trending upwards, you know. I mean, it should be, if it followed the trend line, probably should be up around here, probably up getting close to 180 or something. Should be quite a bit higher than it is right now. So I would say that it's artificially low, because this is something they can manipulate with money behind the scenes. And so this is telling me, this move index, because it broke below its trend line, is telling me that there's stability in the credit markets, and there's somehow they're pumping liquidity into these credit markets, and that's what's been holding the system. That's why when we went down to 3,000 on the stock market, somehow we've crept our way up to over 3,000 points higher than when it went down, when the Dow Jones went down to 30,000, and the markets were falling, and it stopped falling, and then now it's went back up in this bounce. Somehow this is telling me, hey, they did something. What'd they do? I don't know. Bonds and rates. We're falling yields today. 2.84 on the 10-year and 3.1 on the 30-year. And we're looking at 5.3 basis points down on the 10-year. And on the 30-year, 3.7 basis points down. And the dollar index is riding high. And yeah, I would be expecting it to ride high, considering that the Fed is in this tightening process. And they're being really, really tight with the money. Tight with the money, dollar's going to be worth more. As soon as they go back to being loose with the money, the dollar's going to lose value like you've never seen. It's going to drop like a stone in the water. I'm going to tell you, if you guys are hoarding dollars out there, hoping we're going to have a hyperinflation, the hyperinflation might be so short-lived, because when it actually hits, not the hyperinflation, but the deflation, might be so short-lived if you're hoarding dollars waiting for a deflation. It might only last a matter of days or weeks. And you have to look to the other side of that. You have to say, well, what's going to come after that? Well, when the Fed capitulates and starts up the printers again, then what's going to happen after that could happen quite suddenly. Move upwards in all non-dollar denominated assets, massive moves upwards, and maybe they might disappear from you so that you can't get physical. Talking about physical precious metals. And you might have to settle for buying cryptocurrency. to try to get out of the dollar-denominated assets if you wait too long in the dollar. And it might cost you an awful lot more, too, to get cryptocurrencies. They can shoot up, I'm telling you, they can shoot up 30% in a day. So you got to be careful. You don't want to get stuck in the dollar if the dollar is going to burn. And that's what I was saying yesterday about Jim Willie. You know, he always said that the dollar would go up and up and up and up and up, and then just poof, blow up, explode, die. Higher and higher and higher and higher and higher, and it's poof. Anyway, listen. Thank you guys for listening to my show. Like and subscribe, and we'll catch you guys in the very next episode. And you guys have a great afternoon. Bye-bye.